Hey everybody, today is Friday, the 26th of February, 2021. We've just finished the month of February, and let's take a look at the numbers here. The S&P 500 is still positive year to date. NASDAQ squeaked back to positive after being negative year to date yesterday, but still outperformance from the small caps, semiconductors, and oil. So let's take a look at the charts and try to make some sense of it. I always say that risk management is job number one, and risk can come quickly here, as we saw this week. The volume weighted average price year to date is that thick blue line, and we closed just pretty much right at it in the 50-day moving average. So the sellers are in control in the intermediate term time frame. Let's look at a 15-minute time frame. You can see we are below the declining 5-day moving average, and we have the volume weighted average price off the peak still declining. Now Wednesday was kind of strange in that the S&P recovered so nicely but then quickly failed and brought us to new lows. So we have volatility, and it means that we have to take each trade based on its own risk merits and manage it accordingly. If we see further weakness, I think the next logical spot for this market to test would be down here at 373-ish, which is the volume weighted average price off that November peak. That's where we've seen numerous tests held successfully, and if then that fails, the next level below that would be about 369, the volume weighted average price from the November low. So let's go back to a 30-minute time frame, and you can see I've got a number of volume weighted average price levels in here, probably too many, so let's just kind of clear that off. And you can see that this is the month to date that for February that we closed below that, and the year to date volume weighted average price. You don't want to see this type of close on a Friday afternoon, so that just shows there wasn't confidence to try to rescue this market into next week. And I'm going to continue to be very cautious with this market below the declining 5-day moving average. There's no reason to try to be a hero. There is no such thing as support until the market bounces from that level. It's only known in hindsight. In other words, we have potential levels of support and areas of interest, as I like to call them, but we only know support and resistance after the fact. The NASDAQ, as mentioned, basically break even on the year. The volume weighted average price from this November high is what I was pointing to for subscribers as far as where the buyers were showing up and defending this week so far. If that fails to hold, well, then we've got to look at a volume weighted average price from this November low, which isn't too far away. I would also put one off of this peak and off of this low right here. So, down near 300 if things get pretty ugly. And right now, you give the benefit of the doubt to the sellers as we are still below. There's the week to date and that volume weighted average price from the peak. And of course, we have a declining 5-day moving average. When the 5-day moving average is declining, I never look to buy anything. That is, whether it's the Qs, whether it's Tesla, whatever it is. If that equity or index is below a declining 5-day moving average, I consider it guilty till proven innocent. Just like the gold stocks. Gold, we were looking at gold a couple weeks ago thinking maybe there was a potential for recovery. It showed zero evidence of that. Gold is now in a major downtrend. I mean, lower highs and lower lows below a declining 10, 20, 30, 40-week moving average. Silver holding on a little bit better, but still, this was the so-called Wall Street's bet short squeeze. They got hurt pretty bad, I would say, in that deal. And now silver is even looking bad. So the gold miners, of course, are back to a primary downtrend. And one thing to consider there is the REX shares microsectors, where you can trade these things levered up or down, GDXU and GDXD, and they are the sponsors of this show, which is why I mention them today. They're not appropriate for everyone, but if you are a risk taker, maybe that's a way to go. The Russell 2000, you can see this trend line has been important, but more important than that, I think, is the fact that we're right at the year-to-date volume-weighted average price. Now, this market, the Russell 2000, that is, this week showed that we have a little pattern of lower highs and lower lows on the intermediate term. Of course, the longer term trend is still higher. These are what I consider the most relevant higher lows in this uptrend. So even if we were to come way down here, we wouldn't be in a downtrend. But of course, that is for a longer term time frame. My focus is always on the intermediate term time frame. We came down precisely to that year-to-date volume-weighted average price, and this market also below a declining 5-day moving average. means that you've got to be cautious going into next week. It pains me to hear all these people say just buy the dip. To me, that is not a strategy. You have to look at a market and say, if it shows weakness, then you look for evidence that the buyers are gaining control at potential levels of support. And if they do, you buy as the market moves away from those levels. Blindly buying into a decline is a very dangerous strategy, as people seem to have forgotten. But it wasn't that long ago, just a year ago, that painful lesson was something that people learned, and it's not going to bounce back like this every single time. The people who bought in here and held, congratulations, that's great. You learned a horrible risk management lesson. Semiconductors were weaker as well. They're right on that year-to-date volume-weighted average price and holding above the rising 50-day moving average. This group, of course, has been in a monster uptrend. If we fail to hold here, I think that maybe a couple of these levels would be tested next. And the biotechs, we exited these on the long side over here a couple weeks ago. We looked for the potential that maybe the buyers would regain control. They didn't. So with the declining 5-day moving average, we can look for reasons to buy, but we have to wait for price confirmation that the buyers actually are in control before we buy. And standing aside while the market declines and not having your money at risk is a great way to stay ahead of the game and not feel like you're connected to each and every down tick and hopeful of every single rally. It's just a terrible place to be. I've been doing this now for 30 years. This is my 30th year of doing this, and I've had alpha trends for the last 13, I think, years. I've been doing this, like I said, every single day for a swing trade time frame. Now, not everyone's time frame is swing trade. That's mine, and that's what I think is the best time frame for a portion of your money. I will tell you for the last time that I have a sale right now that is $5.99 for a year. If you're interested in learning a strategy that you can repeat on every single time frame and primarily focused on a swing trade time frame, then I would encourage you to take a look, alphatrends.net/599. This will be the last time this price is ever offered, I promise. And I don't give the hard sell. If it's for you, take a look. Lastly, we'll talk about the financials, which are still in a primary uptrend. They've been the leaders. And right now, it wouldn't be surprising to see them pull back to their breakout point, which was at about 31.5. That's also where we have the volume weighted average price from that prior low. I will probably post some charts this weekend of some opportunities that might be setting up. But otherwise, enjoy your weekend, and I'll talk to you next week. Thank you.